Pack a pretty wild business mystery. It's a story that proves why, in the world of retail, how fast you can sell your stuff is often way more important than how much you make on each thing you sell. I mean, think about it. How does a company that's making billions of dollars in sales just go bankrupt? You see their stores everywhere, they're a household name, and you just assume they're doing fine. And then poof, they're gone. It doesn't seem to make sense, right?
Well, that's exactly what happened in 2023. A true giant of retail, a place you'd go for, everything for your home, just vanished. It left behind all these empty storefronts and a ton of questions.
Yep, we're talking about Bed Bath & Beyond. And to really get why it failed, we have to start with the story the company told everyone about itself.
So, in their official bankruptcy filing, the company pointed to some pretty predictable problems. They said their supply chain were outdated and supported by old systems. And look, that's a familiar story, and it wasn't wrong. But that official story, it's not the whole story, not even close.
Because, when a huge retailer like this goes down, there's always the standard lineup of suspects that everyone blames. And here they are, the usual suspects. You've heard this a million times before. People aren't shopping in stores as much, e-commerce is taking over, stores aren't performing well. And for Bed Bath & Beyond, yeah, all of that was true. They were absolutely part of the problem.
But what if those were just symptoms of a much, much deeper sickness? What if the real killer wasn't Amazon or changing shopping habits, but a single number hiding in plain sight on the balance sheet? A number that measures one simple thing: speed.
And this is where we get to the heart of the matter. We're going to look at a concept that doesn't really make headlines, but it is absolutely crucial for understanding if a retail business is actually healthy or not.
That metric is called inventory turnover, and put simply, it's how fast you sell your stuff. So if your turnover is, say, 4, it means you sold and replaced everything in your entire warehouse 4 times in 1 year. It's not about how much profit you make on one towel, it's about the velocity of your entire inventory.
And here it is. This chart right here is the smoking gun. Back in 2019, a group of investors actually tried to sound the alarm with this exact analysis. Just look at Bed Bath & Beyond, that one in blue. While a competitor like Target was turning over its entire stock 5.6 times a year, Bed Bath & Beyond was stuck at a painfully slow 2.9. They were one of the slowest in the entire game.
So let's translate that into something that makes more sense. A slower turnover means your products are just sitting on the shelf for way longer. At Target, an item sat for about 65 days before it sold. But at Bed Bath & Beyond, 126 days. For over 4 months, that one product was just sitting there, collecting dust and tying up cash.
So why is this such a big deal? I mean, who cares if a toaster sits around for a few extra months, especially if you're making a good profit on it? Well, this brings us to the core lesson. Why in retail, being fast is almost always better than being fat with high margins.
See, here's the critical part. Inventory isn't free. Every single day a product sits on a shelf, it's costing money. And storage and insurance, they call it carrying cost. Then, to get rid of the old stuff nobody wants, you have to do massive markdowns, which completely kills your profit. And all the while, your cash is literally trapped in those unsold boxes. Cash you can't use to buy new, cool stuff that people actually want to buy.
This really lays out the two different philosophies, right? A fat strategy, focusing on high margins, feels good on each sale, but your money is constantly tied up. A fast strategy, focusing on high turnover, keeps cash flowing, it lowers your risk, and it lets you jump on new trends. The really healthy companies, they find a balance. Bed Bath & Beyond, they did not.
And believe it or not, there's actually a metric that combines both of these ideas, margin and speed, into one powerful number. It's called GMROI, which stands for Gross Margin Return on Investment. You just multiply your profit margin by your turnover speed. This gives you the ultimate report card, how much profit you're actually making for every single dollar you have invested in your inventory. Okay, so how do the successful companies win this game? How do they keep their stuff flying off the shelves quickly and efficiently?
Well, it really comes down to being disciplined and using data. They use modern tech to know exactly what they have and where it is, all in real time. They look at the data to predict what customers are going to want, so they don't overbuy the wrong things in the first place. And they make smart choices about what to stock, focusing on what sells, not just on what has a big price tag.
And this brings us back to the really tragic point. Those same investors, they did the math. They figured out that if Bed Bath & Beyond had just improved its turnover to be slightly below the industry average, not even great,
just not terrible, it would have freed up over $500 million in cash. That's $500 million that was just sitting on their shelves, cash that they desperately needed to invest in their stores, their website, their own survival.
So the final lesson here is pretty clear. Profit margins are important, sure, but they don't tell you everything. The real lifeblood of a retail business is cash flow, and cash flow is all about speed. That hidden velocity of a company's inventory can be the difference between thriving and disappearing. So the next time you walk into a store, are you going to be looking at the prices? Or are you going to be watching how fast they restock the shelves?